oil falls, the more the natural gas is likely to rise. Looking at the correlation and breaking it down, you can see what's happening. When we compare this situation to the dollar, we can actually see for a short period of time, the dollar and light sweet crude oil actually went up together. But in most cases, that's not it. You can see the dollar goes down, light sweet crude goes up. So if we're looking at a continuation of this bull dollar move, oil only has one way to go, and that's down. So any move higher, we would use it to sell. Now again, looking at ranges, a range is something that's determined that basically we're repeating back and forth. There is no range in this 103 area between 95. We've got a repeated challenge of the 95 of the Vantage Point 18-day predicted moving average. Now let's bring up the main oil chart again. Now when we look closer at the light sweet crude oil contracts using the medium-term crossover from Vantage Point in conjunction with the predicted MACD and the predicted TSI, this is why the recommendations I've made here on Trader Planet and to my own clients over the last several weeks is to sell light sweet crude. We have been selling aggressively in the 98 level, 98.50 and even 97.50 now towards the latter part of the week. Based on this, we can see that we've repeatedly had lower highs and lower lows. On Friday, we've actually breached the 95 level slightly. I would anticipate this particular type of rally to continue. But again, when we look at talking about ranges and things like that, ranges are not really determined in a 1 week period. They're determined over a longer period of time. And again, with single market analysis can very clearly get you buying when you should be selling. So just something to take into consideration. Now when we look at gold to start the week, we're again seeing some support giving way here. This trade has been in progress. This short gold trade has been in progress for, this is probably about a week and a half. It's been moving aggressively lower. Now when we look at that same setup on the medium-term crossover, much like crude oil, we were way ahead of the market. When everybody else was buying crude oil, we were selling. When everybody else is buying gold, we're actually selling gold. And this move looks like it potentially has some legs. Now, further Eurozone crisis, that could help gold, but right now it appears to me that they're moving into dollar-denominated assets, not into gold. The one thing we always want to remember with gold, gold is not backed by anything. People can say, well, the dollar, the euro, it's a piece of paper. But it is backed by something, by that government is going to pay this debt. Gold is 100% speculative. So suggesting gold is a safe haven, that's not an accurate statement in my respectful opinion, because of the wild moves we're seeing in gold. I do not, and I would not in the future consider that to be a safe haven of any kind, just to be clear. Now looking at silver, we're seeing a very similar pattern there. Silver has as of late has had a very high correlation to the S&P 500, and you can see as the S&P 500 sells off, silver follows. So I don't expect a great week ahead for metals, to say the least. Japanese yen futures contracts is certainly worth a look this week. We can see that the yen currency futures are coming under pressure. They do have some exposure to the Italian banks, the Italian debt. So again, if we take into consideration what I've said, what's happened in the past in this type of recession environment, it always starts with the US. Then it usually, 9 times out of 10, will move to the Eurozone, and then we look at the emerging markets. So the emerging markets are going to have a negative effect on the yen. So selling yen, potentially a very good play in the weeks and months ahead, keeping that in mind. U.S. Treasury notes here, they're holding their own, but they were coming down and testing this key support level in this 130 level, but it's holding. So I expect the 10-year notes to follow the dollar in this particular case and to hold their value. Looking at the Euro FX futures contracts this week, certainly not looking good here, and believe it or not, they're not oversold on the futures side. So we're using a quick view of the futures to help us with the Euro US and some of the Euro currency pairs in the Forex market. So right now we've got some key levels, 135.60. I think we're going to have a lot of sellers between 133.40 and 135.60 on these particular futures. Now, coming into our direct currency pairs, the Aussie-US currency pair key level 1.0016, just above parity. We've moved all the way down to the 97 level. Aussie-US is going to, the Aussie dollar is going to be dragged around by the equity markets, risk on, risk off. I think it has a rough road ahead, but it is still a high yielder, and the bigger Forex traders are going to want to get long on this and try and keep this pair higher so they can get paid swap on a daily basis by the brokers. Very attractive long trade on the Aussie US, but not a very attractive from a medium and longer term perspective. From holding this particular currency pair, it's a reverse carry trade because we would actually have to pay the brokers. So not great in that respect. So I'll always be looking for a bounce, but right now we're looking pretty bearish for the week ahead. Euro Swiss franc, we're starting to go flat here, 123.23. We've closed right on that level. The Swiss National Bank is going to have their work cut out for them, guys. That's the bottom line here. The key level is still the 120 level if they can keep this thing propped up, but I would anticipate we are going to retrace lower on this particular pair, probably towards that 120, 150 area. That's where they came in last time, or rumored that they came in. So for now, I would stay clear of Euro Swiss franc. Pound dollar looking bearish also. I talked about this extensively last week. If we break this down into the Vantage Point medium and longer term crossovers, you can see when used in the combination of the other indicators and then cross-referencing it to the other markets, the equity market,